Guys, to another video. In today's video, we're going to be discussing how we can navigate the higher time frame swings in the market, how we can use the higher time frame to anticipate where the next draw on liquidity is, where the market is most likely to trade towards next, and how we can use this information to assist us on our lower time frames and the kind of behaviors and delivery that we can expect on our lower time frame in each phase of the swing. So when we're talking about swings in the market, we're talking about the standard price delivery that we're all familiar with, right? When price is, in this scenario, making a high, a low, a new high, a new low, a new high, a new low, and we're forming this bearish market structure, right? Where price is putting in highs, not taking out these highs, putting in lows and taking out these lows, as you can see here, and then making lower highs, lower lows. And you can see that in this overall structure of the market, these sellers are in control. But it's very easy to just throw this theory on and disregard the more intricate decisions that need to be made and the intricate scenarios that can play out in the market. But overall, I want to show you how we navigate each leg and what parts we want to be participating in, which parts we don't want to be, or what phases we want to be participating in, which phases we don't want to be participating in, and how we manage risk in each scenario. So let's first start with the theory of the swing and what a lot of you guys will be familiar with in terms of the market maker model. But before we start with that, I want you to understand there is no such thing as a market maker model. There is no one that sits in the market and says, okay, cool, we're going to put this low in and now we're going to start pushing price higher to stop out anyone, that is, any stops that are in this leg. Let's say there's some kind of interim liquidity here, and we've got sell limits over there, or stop losses over there. There's no one that's trying to target these to take you out and then dump price in the opposing direction. That's not what's going on, and we're going to clear a lot of that and explain more concise and logical theory behind these moves. But understand there is no angry market maker that is there to try and take you out. There's a much larger purpose of the market, and the larger institutions, these market making capable participants, they're not out here to do you dirty or do you wrong. They have their own agenda and own activities that they need to carry out that have nothing to do with you or us as the whole in terms of retail liquidity, right? So what is really happening in these swings that we're talking about? So the first thing that we will notice is that the market will tend to leave behind major swing points, right? So if we just switch this up to a solid line, right, you will always see that there are at least two swing points in the market which will be solidified as clear areas on our chart where buyers and sellers were present, right? Or buyers or sellers. So in this case, you see sellers had stepped into the market to drive this leg down. And then over here, we have a definitive point where buyers stepped into the market to drive this leg up, right? But we know that this area and this area are areas where price was generally deemed as expensive and generally deemed as cheap, right? So now we're set with a framework where we're set with a framework where we understand where price is deemed as cheap and where price is deemed as expensive, right? This is the most fundamental and most basic understanding that you need to acquire in this market, right? So anything at 50%, so let's say this is our equilibrium here, anything above this is deemed as relatively expensive, right? Internal to this range, and anything above this is also deemed as relatively expensive, right? External liquidity wise, right? So you have internal liquidity, you have external liquidity. This is deemed as, expensive. This is deemed as expensive. Anything below this is deemed as cheap, right? And anything below this externally is deemed as cheap, right? So you have these areas on your chart where your exchange is deemed as relatively cheap, or expensive. So if we was to get rid of this and slap this onto a chart over here, you can see that a good example of this, right? If we come out of that and take this, and in fact, we can begin to let this play out, right? What we see here is that we have that area on our chart where price is deemed as expensive, right? This high, which was isolated, this low, which has now been put in place. And you know, universally, right, on a relative level, so to speak, this area, if anyone was to look at this chart, you can say that this area is relatively expensive and this area is relatively cheap. Obviously, it's relative because you have cheaper areas down here. But on this leg, this is what we can deem as expensive and this is what we can deem as cheap. And then to add on the extra tool that we were speaking about, right, where you can get your EQ as such, right, anything above this area is what we can deem as expensive, and anything below this is what we can deem as cheap. So understand now that in this leg, to go from here to here, right, the market shifted from being relatively liquid to being relatively illiquid. Now, it's not super illiquid over here because in extremely illiquid conditions, we get these imbalances that we can see here. In this scenario, we don't get that, right? But you can see that this is illiquid, right? And when we talk about price being illiquid, we're talking about not either, number one, there not being many participants available or present in the market, right? So in terms of liquidity on either side of the book, there's not much available, so it's easier to push price in either direction, right? Or we have a lot of participants transacting in the same direction, which in itself causes a illiquid environment due to how liquidity providers will reprice their liquidity or requote their liquidity. But the overall thing we want to understand is here we have efficient delivery, right? As price retraces back into this previous leg, right? We order pair up here, get a transactable environment, a liquid environment, and then eventually liquidity gets injected, and then we get this relative inefficient delivery to the downside. On a lower time frame, we would have seen those imbalances. On our daily, we don't get it, but we can see that there has been a shift in the state of delivery, and that shift occurs in this candle, right? This is the candle that pushes us down. We get 4-hour imbalances, I'm pretty sure, right? Here, bang, shift. So you can see, again, if we get rid of all of this, you're going from highly liquid and transactable to highly illiquid over here and less transactable, right? So that is our shift right here. That is that shift. But you can see this, the change in the state of delivery from liquid to illiquid over here. And then we get relatively illiquid down here as well. So the point I'm trying to make here, right, is that to go from here, from this high where price was deemed as expensive to this low, we had to inject liquidity, not we, but market participants had to inject liquidity into the market, meaning that they had intent to push price lower. They intentionally was injecting orders to push price lower. Now, what that means is that in this area, right, we have participants who were selling the market aggressively. Now, when the price shifts from liquid to illiquid, right, from liquid to illiquid, we are presented with an area on our charts where, like we said, price or the market was deemed as less transactable. So whoever wanted to sell in this leg down didn't have the ability to fully fill those orders, right? Because price is illiquid. There's not many participants available in this region. This is a risky scenario to participate in, number one. And number two, you are exposed to slippage if you are trying to sell at the market in these conditions, right? So this becomes a environment where participants do not want to transact and where it is difficult to transact. So let's say you had some sell positions here. You tried to fill a client order for, let's say, 100 million. You fill some of that here. Let's say you fill 25. Let's say you fill 50 million, and then price runs down, right? You cannot transact that. You cannot transact that order. You cannot continue to fill that order in these conditions. So as price moves down and down and down, what can happen is that these orders get left behind, right? They get more or less dragged along or get left open in the market, right? And can get cancelled at a later date. So just because it was placed in this region doesn't mean that if price moves away, it gets cancelled. These orders can get left in the market for extended periods of time. So when that when the market retraces back into this region, there's liquidity being provided in this area still, right? Because you have half of that order that still needs to be filled. We said that 50 million got matched in here. Price moves away. We don't get to fill the remaining 50 million, but as price returns to this region where we couldn't transact, that liquidity can be re-injected into the market and can continue price towards this low, right? So we understand that in this leg, there is a lack of liquidity available, which means that whoever wants to transact here, whoever wanted to sell and even buy in the market was unable to. So this represents an area where price was unable to transact fairly, right? Meaning that there is leftover or unfilled intent or unfilled orders in this region. So when price returns, it acts as an area where liquidity can be re-injected because it wasn't able to be filled before, right? So we understand that now. We understand the importance of this leg down, and we understand what happens and what can happen if price returns back to that region. Now, we know that, cool, we are fulfilling intent, but the market can't move in one direction forever, right? We're not just going to keep pushing lower and lower and lower and lower. What's going to happen is that we're going to eventually take out areas where price is deemed as cheap, right? So this is an area on our chart where price was previously deemed as cheap. We transact into that. We push a bit lower, right? We can see that there was no real liquidity being found here. Price did not stall here. Rather, we have to move lower to find these counterparties, right? These buyers. Sellers are stepping into the market. We're seeking buyers. We're seeking opposing liquidity. And that gets found after we take out this sell side liquidity. You can see how we transact there for a short time. And then we come down to here. And then we begin to stagnate. We begin to pair that liquidity. We find liquidity. Those sellers that were stepping in here are beginning to exit the market, and their orders, right, are being paired more or less down here. Make sense? So we now have this area where price is deemed as cheap. Sellers are stepping in here, right? We're seeking the opposing liquidity, right? If we're selling the market, we're looking for buyers, and those buyers get found down here, right? And that's why we see this stagnation in price. There's no liquidity relative to this time frame being found here. Price doesn't stagnate. We find a small pocket here. We don't stagnate for too long, right? We just pull back and then dump, and then we transact below here. And you can see we get this large stagnation where liquidity from this leg is being distributed. So now we need to start identifying these areas that we spoke about over here where liquidity can be re-injected into the market. And we said that tends to happen in these areas where we get imbalances, but on this time frame, we do not have any open pockets over here, right? We do not have any open pockets in this range, right? In this area where price is deemed as expensive, right? That's where we're looking for these pockets in this region over here, right? You see, we don't have that. We don't have that. The only array that we have is this order block over here. Right, so this becomes an area of interest. When you have these areas so far away from your EQ, this also can become an area of interest where you can look at price potentially stalling, and you could sometimes get reactions from there. So we're gonna mark this as our EQ, right? And the last area that we were looking at is this area here, because this represents an area where we had selling intent before. Prior to this move down, we had sellers stepping in here, right? Price came up, and did whatever it needed to do. We order paired and then we move lower. But this shows an area historically where sellers were willing to step into the market. So these areas here become our, more or less our POIs, right? And the reason why this bearish OB was so nice as well is because of the amount of volume that had occurred here. We have this two-way transaction where buyers had met sellers and we had this transactability. We didn't have any intent coming down here on this daily time frame, so we had no imbalance to trade away from. But what we do have is an area where volume was being transacted and where price can come back into that area of volume to pick up liquidity and then dump lower. So that was the kind of thought process here. And then on top of that, we're also transacting in this expensive areas on our chart where sellers also will be looking to participate, right? So this takes us into another topic, which is whether we are pro stage or counter stage. So pro stage is when you are trading towards your draw on liquidity. So in this scenario here, we understand that we are distributing liquidity because of the wicks that we have down here and the stagnation. We're not isolating this level over here. Rather, we're hanging around here. We're not injecting liquidity rapidly after taking out these areas of sell side liquidity. Rather, we're hanging around. And when price hangs around at these levels, we're more or less, there's a higher probability that we're going to take these levels out in the future. So we understand that. We understand that we're hanging around here, right? When this high was isolated, this high is not being, this low is not being isolated, and it's higher. There's a higher probability that we stay away from this area, and that after we fair evaluate this move, right, we transact back into this area. So that was the kind of narrative. So trading into this area is pro stage, sorry, and trading away from this here is counter stage. Counter stage is a higher risk environment because if you know your draw on liquidity is lower, right, trying to buy this up is risky because price can drop from here, price can drop from here, price can drop from here, right? So you're buying against the wind, so to speak, or you're buying against the higher time frame flow. So you are in riskier conditions, and in those conditions, we want to risk half, right? So if your standard risk is 1%, right, that would be your pro stage risk. In counter stage, you want to be risking 0.5 or lower, right? So that is the risk appetite or the risk management that we're dealing with in these scenarios. So if I play price now, you can see that price ends up pushing higher, we end up pushing higher, and we leave behind this imbalance. And a lot of people would say, okay, cool. Why then is this not deemed as a impulsive leg higher, right? If we're not leaving any imbalances over here, why would you not begin to consider that price can start doing this? And that is, you know, a fair conclusion to come to. But what you have to understand is look at the nature of this low, right? Where we haven't grabbed liquidity. These are equal lows. If we look at this from this perspective, we have the low being 15421 and 15423. Is that 3? Yeah, 15423. So 421. So in this case, we actually do trade below this low by, you know, a very small amount. But again, the more important aspect here is that DXY did not. So we had negative divergence, meaning that we're most likely, even though EU did this, right? DXY did this, which means we're most likely going to, you see how we have that divergence here, meaning that we're most likely going to come and correct that, meaning that we're most likely going to trade back towards this region, right? The other point that I want to make clear is the reaction again from taking out these areas of sell side liquidity. Look how we react when we take out this area of liquidity. We isolate this area here. Look how we react when we take out, you find a good example, this area, we isolate, right? In this scenario, we are not isolating. We come down, we hang around. We come down, we hang around. We come down, we hang around. We come down, we hang around, right? So we're looking at weaker areas compared to stronger areas. We want to trade away from the stronger areas and towards the weaker areas. So now all we're waiting for is one of these POIs, these areas of interest where we can see liquidity being injected into the market again, be tapped into, and then we can begin to look for those continuation plays. And in this case, you can see we tap into that area there, right? Into our OB. You can then see we tap into that imbalance that was left behind as well, right? There where we had that previous selling intent. And then what we see here is a nice injection wick right there, where you see that we have this high here on a fractal level. What we do is this, right? That is more or less what that is showing us, that injection of liquidity there. And once we see that, we can begin to look on our lower time frames for those short positions, right? So what we will do is just take this. Right? Cool. Now you understand that we are entering these pro stage scenarios, right? And the reason why we manage these trades differently is because of the nature of delivery that we're most likely going to get in these pro stage moves. So you can see that as after price tapped into that higher time frame array, so what we can actually do is leave these on. Right, so you see we tap into that, especially this volume region. And another thing I want to show you would be this. Right, look at where, this is where price becomes efficient, right? Sorry, it's not what we wanted. This is where price becomes efficient, right? If we draw it down to the low, you can see that our POI, or where price becomes efficient again, after transacting in a relatively illiquid manner, is up in this region here, right? This is our area where the majority of transactions occurred. You can see that it significantly drops as we extend down here, and the further we get away, the more illiquid it gets at these extremes. As soon as we return back into this high volume area, we pick up liquidity and we begin to flip over. And look how we are now isolating this high compared to these lows over here. These are not being isolated. Rather, we're leaving behind these weak lows that we can trade into and slam. I don't know why we're not. Okay, there we go. Right, these equal lows that we also have that divergence with DXY. Right, bang. So let's get rid of that. And now, once we see price tap into that array, we're starting to pay attention to the order flow and the delivery. So what we see here is that we take out this bullish imbalance, right? This was buyers showing intent to push price higher. We take out all the intent that was displayed on this leg over here, right? We take that out. This is the first time in this leg that we induce an array, right? We get very small bullish OB, bullish imbalance. Again, transactable areas, this bullish OB, we get bullish imbalance, which gets respected. Now, after tapping into that POI that we had, that's the first time we inject liquidity and disrespect or induce a bullish array, right? So we get bearish closure after trading through that array. We now leave behind a bearish imbalance, right? So let's get rid of that. We know that this has been induced, showing that sellers are now stepping in a bit more aggressively. But ideally, what we want to see, that final confirmation of that strong rollover, is closing below this low down here. Right, that's that shift. So we get bullish arrays being induced, bearish arrays being created, which you hear me say time and time again. And then the final piece of that puzzle is the closure below that shift, right? Now what we get is a full strong rollover where we have isolated this high, right? And we're most likely not going to return to these areas up here, and we can start to trade towards these lows down here, right? This kind of sell side liquidity pool that we've had down there. Right, so we see that, blah, 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 blah. Now we want to start looking at these 4-hour arrays and trading with them, right? And now what you want to understand is that the delivery 90% of the time, and obviously that's not a driven fact, but the majority of the time, these moves here, right, these impulsive legs, these pro stage legs towards your draw on liquidity tend to have a lot more shallow pullbacks, right? So you tend to see these highs get taken out a lot less. These liquidity grab scenarios don't happen as much, where we're needing to seek expensive areas on the chart. We don't see that happen as much because the swing's in full effect, right? We don't need to pull back as far to find the necessary liquidity to push price lower. Buyers are not really present in the market and sellers are stepping in with intent. So if we have a look at this scenario was a bit different, right? But you can see that once we sync up again, which we'll get through to in a minute, we don't really get these pullbacks. So we go to move lower, but you see that we encounter this imbalance over here. Price taps into that and begins to distribute, which leads into this pullback that we get over here. But you can see that we're distributing liquidity rather than injecting liquidity. Look again how this is a sign of a weak rollover. We're not leaving behind any imbalances, no imbalances, even though we're taking out these highs, right? We're not leaving behind any intent to the upside. So that still gave me the confidence that we're most likely going to continue to trade down here. We just need to trade into an area on our chart where sellers are willing to step back in again. No arrays really over here other than a daily order block, which was that over here, right? And then again, you compare that up with some kind of fair valuation or EQ of that most recent range, right? Which puts us here. You can see we've tapped that already. So all we need to see again is some kind of topping out of price to then allow us to drop again. And to put it into perspective, you can see we have this kind of OB over here, right, which price taps into, this kind of shoulder where price runs into, and you will see that we end up pushing away from that, right? Now, notice again that as soon as we flip and switch into that pro stage scenario, watch how inefficient price delivers to the, or inefficiently price delivers to that low, right? This is why we are a bit more aggressive in these pro stage scenarios, because the chance of price doing this is a lot less likely. If we go into our 1 hour chart, let's look at the highs that get left behind, right? You'll see that we don't really return to them. So high doesn't get returned to, right? High doesn't get returned to, high doesn't get returned to, high doesn't get returned to, high doesn't get returned to. All of these don't get returned to, all of these don't get returned to, all of these don't get returned to. Only once we start tapping into that imbalance that we saw here. Now that has been used already, right? We have these two areas that we're looking to trade into here. We shouldn't take out any of the highs that get placed in on this leg down, right? So we get this high here, right? We show that shift in delivery or that liquidity shift